If you're watching this video, congratulations. Most traders will scroll past this and never understand why the market moves the way it does. But you're here, and that means you're about to unlock a skill that separates the losing majority from the traders who actually win. Today I'm going to show you the order block setup that the smart money doesn't want you to notice, the exact pattern they use to engineer liquidity and drive price straight into profit. By the end of this video, you'll never look at a chart the same way again. Let's begin. There are three main types of blocks in the market: the order block, mitigation block, and breaker block. In this part, we will analyze the most popular one, the order block. This tool is significantly more effective than standard support and resistance levels. By applying this knowledge correctly in practice, you will noticeably improve your trading results, and your effectiveness as a trader will significantly increase. Let's look at the charts. This consolidation range is the accumulation zone of a large player, where they were building their position before moving the price in their desired direction. This very zone is the order block, following the classical technical analysis from various books. The entry point for us would be a retest of this very range. If we consider this situation from the perspective of the smart money concept, within this larger range, we should find an even smaller consolidation range from which we could open long positions. Thus, entering based on the microstructure significantly reduces the potential risk and increases the potential profit multiple times. Therefore, this concept is much more beneficial for us as traders. Before we move on, let's figure out what is happening inside this range. So there is a bank that instructed its institutional trader to accumulate a position, for example, worth $500 billion. No market participant can execute such an order at the market price, so the large player has to improvise. They start placing limit buy orders at their desired price level, for example, for 5 to 10 billion at a time. Let me say in advance that all the figures are unrealistic and are used simply to make it easier for you to understand the mechanics. However, the first problem the large player encounters is that the market starts bouncing off their large money. Retail traders enter, the price gains momentum, and moves away from their average price. So they are forced to place limit orders on the opposite side of the range to prevent the price from going higher. So the price fluctuates within this range until the large player has executed all their 500 billion. Once they have executed them, the price takes off. But here's the catch. They encountered another problem. The issue is that retail traders, meaning us, saw this range, or some other technical analysis pattern, and also decided to go long. This means the market liquidity has decreased, and the large player has no one else to buy the asset from. They place their stop losses beyond the boundaries of this very range, meaning beyond the nearest high or low, according to standard classical technical analysis. In this situation, they place their stop losses here, and in this context, stop losses are market sell orders. Additionally, traders using breakout strategies join in, and also place pending sell orders in the same zone. As a result, a significant amount of liquidity in the form of pending sell market orders accumulates beyond this boundary. Therefore, to fully build their position, the large operator is forced to spend a portion of their funds and push the price down to execute their own orders and absorb the crowd's pending sell orders. After this, they can freely drive the price in their intended direction. However, before doing so, they left a trace in the form of an order block, which we can utilize. The probability that the price will return to retest this zone is very high. And why is that? Earlier, I mentioned that the large player has limit sell orders in place to prevent the price from moving higher. They also spent part of their capital to push the price into the liquidity zone. Some of these orders might still be active in the market, so to close them and break even, they are forced to bring the price back into the zone. This is how mitigation and breaker blocks are formed. We will discuss these blocks in the next parts. Another reason for the retest is to finish accumulating their position. This is because during a strong price movement, retail traders start joining in, buying at the very highs, and they place their stop losses in the accumulation zone of the large operator. Now let's return to the order block. So the order block itself is a formation in the form of a single candle, followed by a strong rise or fall. It can be found absolutely everywhere, on any time frame, any currency pair, any asset, and there are several ways to identify it. Today we will talk about the classic method. And if you find this topic interesting, I will record additional methods for identifying order blocks. For now, let's move to the charts, and I will show you all of this in real time with an analysis of my recent trades. And before the video starts, I recommend subscribing to my Telegram channel, where I share a huge amount of useful trading information and share my thoughts on the market. You will find a lot of useful and interesting information here for yourself as a trader. Follow the link in the description. I think you have probably already seen some previous videos about order blocks where various individuals share, let's say, not always accurate information. Perhaps you've heard there that an order block is a specific candle that must look a certain way, with its own parameters, for example, a small body, small wicks, and so on. But that's all nonsense. An order block for us can be absolutely any candle. The candle could be this size, hypothetically, or it could be a pin bar, or a hammer, or, I don't know, a doji. That is all completely unimportant. The main thing is that after one such candle, we get a series of descending candles moving down. And when identifying such a candle, there are a huge number of nuances, which I will now tell you about. We will start from the very basics, which is market structure. So look, we have, let's say, an uptrend. Suppose the price is rising like this, and then a structure break occurs. That is, it's clear we had a higher high here, which became a lower high. Here, we had a higher high. Here the break happened. And here we had a lower low, which became a higher low. And here a new lower low formed. What happens in this situation? After an uptrend, when a break occurs, it means a large player has entered the market here and started pushing the price down. Following the classic approach, we should wait for a correction here, roughly into this zone, and then look for an entry point to sell. But look at the situation. Most people think that since the price went down from here, there must specifically be a support level or a resistance level here. But this is fundamentally incorrect because if, for example, you have ever used the volume profile and know what it is, if we apply the volume profile, we will see that here, roughly in this zone, there will be virtually no volume at all. This is because it's a so-called false breakout, a liquidity grab, targeting the liquidity that was located here. Therefore, the largest volume will be located roughly in this zone. And why exactly this zone? Because this is where the price made the most frequent contacts. Suppose we have some level, and the price touched it frequently. There was an approach here, a breakout approach here, but there was also a touch in the opposite direction. Again, in the current situation, it might approach a bit closer, touch here. Consequently, this is why the largest volume you will see on the volume profile will be located approximately in this zone, and this zone will represent for us a kind of range where we will look for an entry point. Knowing that the large volume is located somewhere in this zone, and knowing that the large player initially started their selling from here, then entered again higher up, took out this liquidity here, and then moved down, breaking the structure. This means that this very move was nothing other than a false breakout. Therefore, we will not look for entry points from here, because the initial selling started from the previous lower high, that is, from the previous peak. In this case, it's a peak. Accordingly, if we look at this situation from classical technical analysis, it would resemble a kind of head and shoulders pattern. We have a shoulder, head, shoulder. But from the smart money perspective, everything here is completely different. In reality, we will only be interested in this very previous lower high, because that's where the initial selling started. Initial selling, liquidity grab, structure break, correction, entry. That's it. This is the situation we need to identify. So, remember this structure, print it out for yourself somewhere, memorize it, and always keep in mind we need to look for a structure approximately like this. We might not notice it directly on the candles, but in our minds, we must understand what is happening here. Initial selling, liquidity taken out, structure broken, correction made, and then the move continues. That's it. This is the classic approach, and it's by this classic method that we trade. Now, let's try to find this situation in the market. Let's take the current situation on the euro. This is the hourly time frame. We don't even need to look far. Here's the first thing that catches the eye. Here we have a specific situation. Look, you can see this large green candle that took out the liquidity. We could also identify the last one, meaning this small red doji that occurred before it. Some candle took it out, and then an inside bar formed. I will explain inside bars in the next part. And again, these are the nuances of certain order blocks. So, based on this red candle, we draw our order block, because a liquidity sweep and structure break occurred here. Let's observe how the price reacts to it. The price perfectly enters it, gets rejected, and moves away. Accordingly, we can place our stop loss right beyond the order block, not beyond the absolute high. Placing it beyond the absolute high would be safer, of course, but if you are focusing on your win rate, or rather on your risk-to-reward ratio, it's still better to place it just beyond the order block itself. Yes, you will have more stop-outs, and yes, beginners might not always identify it correctly. So this simply requires practice, and more practice. But in principle, even if you place it beyond the high, your risk-reward ratio won't deteriorate significantly. So, look, we simply place a limit order, the price approaches, we place our stop here, just beyond the order block itself. The price didn't touch it and moved further down. We can find a huge number of other order blocks here. Look, here, see this candle? There was this red one, followed by a wick. That's our structure. Some buying occurred, the price takes out the liquidity, moves away, and breaks the structure. Therefore, based on this candle, we draw our order block. The price enters it, touching it 9 times. Then it enters again, 1, 2, 3, 4 times, and yet another time it enters. How many times did it enter this very order block before finally breaking through? And look, we always identify order blocks on higher time frames first, and only then do we move down to lower ones. Specifically, look at this hourly chart. We found an order block. The last candle is red, after which a liquidity sweep occurs, the structure breaks, and we highlight the last candle. Then we switch to a lower time frame, for example, the 15-minute. And here we can find an even better situation. What do we see here? We see specifically this candle. It contains 2 inside bars, but I've already covered that in another video. So, we are effectively scaling down our order block. Here, the price reached it perfectly. Here, it just barely touched it. And as we can see, by scaling it down to this time frame, the price comes into it perfectly, getting rejected literally tick for tick. We can find this absolutely everywhere, on any time frame. Here we have a beautiful situation. Look, there was a red candle, followed by an inside bar, then a false breakout and a move away. In fact, if we go to an even lower time frame, like the 5-minute or M1, we could find it positioned even higher. And what do we see? Here, the price, well, you can see it, fell short by just a couple of ticks. It enters, slightly overshoots, and then moves away. And we don't need to look far, examples are everywhere. They form absolutely all over the place. Look, we had a large green candle, followed by a small pin bar that took out the liquidity and caused a structure break. Well, also, of course, with an inside bar, but that's not our main focus here. And the price also enters this zone and bounces off it precisely. Here we have an order block. The price also enters it and also bounces off it. Meaning you simply need to learn how to use and apply this tool correctly, and it will work much better than any support and resistance levels, much better than any supply and demand zones. Of course, this topic requires a lot of practice and persistence to learn how to find them correctly and, moreover, to apply them in your trading. But believe me, it's worth it. Spend your time, backtest it all on a demo account over several months. At least 6 months, a year is even better. And when you gain that understanding of how to correctly build these very blocks, then, I hope, everything will work out well for you.